Hi there, welcome to Kneppy Invests. When I first started investing, I found the whole buying process of any company or stock that I liked really easy. So I put an order in and that's it. I bought the company I liked. But when it came to selling out of a position I had bought into, I found that really hard. In fact, I would even say that was the hardest thing about investing. So maybe I'm alone in this. Maybe you are completely different. But I do find knowing when to sell out of position the hardest thing about investing. So it's taken me a long time to figure out some strategies that I can implement to make the whole idea of when to sell a little bit easier. So in this video, what I'm going to do is talk about some of the selling strategies you can implement or I have used over the years. And I'm going to really focus on one strategy that I have started to really use a little bit more over the past year or so. And I actually used this strategy just yesterday to sell out of a position in a stock. Not the whole position, just a portion of the position. So I'll give you that example, also give a few other examples. And one of those examples is a really important reason why I am using this strategy. And then I'm going to talk about the concept of free carry. Now, someone mentioned to me recently that this taking profit strategy is very similar, almost identical to a free carry selling strategy. So I'm just going to talk about that in one slide and then just say whether I like that strategy or not. When I first started my investing journey, having a sell strategy was completely foreign to me. So knowing when to sell, I just had no idea. So I found a company I liked, I bought that company, and that was end of story. When to sell? I don't know, who knows? And I believe that is a big mistake you can have when you're an investor. So I do believe it's very important to always have a sell strategy when you buy into a company. And that is one thing I always do when I buy into a company. I have some sort of idea of what would happen to make me sell out of that position. Now, I also have different strategies for different situations. And the whole reason I have different strategies is because I have different reasons for buying into a position in the first place. And that means I need different strategies. So I'm going to talk about some of those strategies in the next slide. And then I'm going to really focus on the profit-taking strategy that I have employed. There are numerous sell strategies that you can employ in your investing life. You don't really have to stick to one. You can employ them all or a few or ones that suit your own investing style. Now, the first sell strategy I started using well over a decade ago was when the buy thesis had changed. So when I first started investing, I always had a thesis behind why I bought into a company. And if that thesis changed, there is your sell. For example, if I bought into XYZ company because they were expanding into the United States and I thought that expansion was going to be highly successful for the company, and then all of a sudden they got a new CEO and the new CEO decided to abandon that expansion, there would be the sell because the whole thesis behind why I bought into the company had changed. The second sell signal is a technical sell signal, which is something I've started to employ recently in the last few years because I've started to look at charts more and more. And in fact, I've started to buy in companies not because I've had any thesis around the company, but just simply because the share price has been in a well-defined uptrend. And if that well-defined uptrend is broken, then there's a sell signal. And the reason I like this is because the emotion is taken away from the decision-making process. And I actually do like that. The third sell strategy is the stop loss. So I do know a lot of different investors use this strategy, and it's very simple. If the share price of a company you own falls below the stop loss, that's an automatic sell. I've employed this on occasion in the past, successfully and unsuccessfully, and I think it's very important to know where to set the stop loss. So maybe this isn't for everyone. But another good reason or advantage of the stop loss is it does take the emotion away from the decision-making process. But again, I think it's very important you understand where to set the stop loss because you don't want to be stopped out of position when you don't have to be. Portfolio position sizing. Now, this is a sell strategy I haven't employed it in the past, And maybe that's to my detriment, particularly when I look at what happened with A2 milk. So in this sell strategy, it's all about risk management. Now, for example, just imagine you own a company and the share price of that company runs really hard for about 3 or 4 years. The share price goes up 5,000%. And over that period, the size of that holding increases to say 50, 60% of your overall portfolio. So it would be, for risk management reasons, really healthy to trim the position of that holding to a more reasonable size, say 10%, because if something bad happens to that company and the share price decreases by a significant amount, that would be quite detrimental to your portfolio. And that's the reason I probably should have employed this with A2 milk, because at one point in time, A2 milk did take a large size in my portfolio and I was actually thinking of trimming it. And then something bad happened to A2 milk. I didn't sell, I maintained a holding, and it did put a bit of a dent, or is putting a bit of a dent, into my portfolio performance. Share price decrease. Now, I've never used this sell strategy before, but I do know a lot of investors, and even professional investors and fund managers, do use this on occasion. So what it is comparing the share price decrease of a company you own to the overall market. And if the share price decreases of the company is underperforming or overperforming the market, will be highly dependent on whether you buy or sell. So for instance, if the share price decrease of the company it's down 15% and the overall market is up 15%, well, the performance of that company is completely underperforming the overall market, and that would be a sell. Now compare that to circumstances where, or situation where, the share price decrease of a company is down 15%, but the overall market is in a bit of a correction, maybe a bit of a bear market has developed, and the overall market's down 30%. Well, that company has actually overperformed the market, and there's no reason to sell out of that company. And finally, the last sell strategy I'll talk about is profit taking. And I've started to use this sell strategy more and more recently. And the whole reason I've started to use this strategy is all about risk management. And I'll talk about why I use this for risk management purposes in the next few slides. Now I'll just discuss when I employ this profit-taking strategy. So I only employ it during certain circumstances. And these certain circumstances usually revolve around high-risk, volatile plays. So I'm talking about non-profitable, small-cap companies with a low share price. I'm talking about cents, 2 cents, 5 cents, 10 cents, maybe 20 cents, or a little bit more than that. And typically what I'm looking for here is when the share price of the company I own has risen over 100%, and not only has risen over 100%, but has risen exponentially or quite quickly. Because over the last 10 years or so, during my investing lifetime, I have found that when a share price has risen exponentially, it usually ends in tears, and hopefully those tears are not mine. So the whole motivation behind this is for risk management reasons. So decrease the risk of losing any more capital, or just maintaining the capital I have gained on the share price increasing by 100%. So just locking in profits. Sometimes you might hear me say, let your winners run, but this is a different sort of circumstance. Now, someone has recently said to me, this is just a free carrying strategy. So later in this video, I'm going to talk about free carrying, what that means, and whether this sort of strategy I'm using, this profit-taking strategy, is the same as free carrying strategy. So now on to some real-life examples where I have used the profit-taking strategy. So the first example is LBT Innovations way back in 2016. Now, I started to accumulate LBT shares in 2014, and I was able to accumulate 100,000 shares between a 2-year period between the share price of about 10 and 15 cents. And you can see the chart there, share price was doing nothing, not a lot of volume, the market was not really excited in this company. And my whole sell strategy when it came to LBT is if the share price ever doubled, I would sell out half my allotment and just keep the remaining half and to see what would happen. And then in October 2016, FDA approved their product. And the market absolutely loved this announcement, and the share price quintupled in 5 trading days. So what I did was I just subtly changed my selling strategy, and I decided, simply because on that first trading day, the share price increased by over 200%. So I decided to sell 1/3 on that first trading day, and then I decided to sell the second third if the share price would rise another 200%, so that's 400%, and that happened a few days later. And then I decided if the share price got to about $1, I'd sell out the remaining 1/3, and the share price got to $1 about 4 days after the announcement. I think it was 5 days. And it was just luck that that was the high in the share price with LBT. And ever since then, the share price has been dropping. And in fact, today I had a quick look at the share price. It's about 10 cents. So I think it's very important. I think the moral of this story is very important to be flexible in changing your strategy when something like this happens. Now, my next example is something that's been evolving over the last few days, in fact, from when I did this video. Now, it's in regards to Stone Horse Energy. Now, my original purchase in Stone Horse Energy was in January 2021, when I liked what I saw on the charts, in particular with the volume and the share price action. So I decided to buy $2,000 worth of shares at 1.8 cents. And my sell strategy at the time was a two-pronged one. So if the share price doubled to 3.6 cents, I would sell out half of my investment and keep the other half to see what happened in the future, or if I got a technical sell signal. Now, what happened there, I never got a technical sell signal, so I was waiting for the share price to double, and we got that on the last day of trading before Easter. The share price rose 44% in one day and closed on that day at 3.6 cents. So the share price had doubled, so that was my sell signal to sell out half. But I decided to be a little bit flexible and just to see what happened at the open on the next trading day, which was the day after Easter. And Stone Horse opened on that day at about 4.1 cents, and that was my trigger. So I decided, instead of selling out half, I'll just sell out 50,000 shares at 4.1 cents, because that 50,000 shares was equal to my original value. So you can see I sold out of those 50,000 shares, which equaled $2,050, and my original investment was $1,980. So I maintained 60,000 shares to see what's going to happen in the future. Now, the timing of this trade was just fortuitous. It wasn't skill, because I did sell out at the almost high. I think the high for the day was 4.2 cents, and the share price has drifted back to 3.1 cents. So don't look anything into that. That wasn't a skill timed trade. It was just fortuitous. Now, the next example I'm going to show you is the reason I use this strategy. It's all about risk management, limiting your losses or maximizing your gains, particularly when the share price is running up exponentially. And 88 Energy is the perfect example why this strategy can and does work. Now, this company has been a love child in the investing community over the past month or so. In fact, the share price has risen from 1 cent to over 9 cents in less than 1 month, and at the share price high, the market cap of this company was $1 billion, which is quite ridiculous for what they do. Now, you could have bought this company at 1 cent, and when the share price got to 9 cents, you could have been thinking, this company is going to make me rich, oh, it's going to make me rich, blah, blah, blah. But on the first day of trading after Easter, 88 Energy released a very negative announcement to the market, and the share price dropped 67% in one day. And this should show you why the profit-taking strategy can and does work, because you could have locked in some of those profits as the share price was going higher and higher, and you would have limited your losses when the share price decreased 67% in one day. So now I'm going to talk about greed versus fear. Now, typically, fear is a much more powerful emotion than greed, but sometimes, particularly in the small cap sector of the market, greed sometimes can be significantly more powerful than fear. And you can see that with the 88 Energy share price action over the past month. So when the share price of a company increases by a huge amount in a very short period of time, investors can become greedy and irrational because they think this company is going to make me rich. And I think it's very important in these sort of circumstances to push aside your emotions, because your emotions can really affect how you make decisions. And I think it's very important to rely on reason and rational thinking, because when you do that, you can make better decisions in the long run. So this is why having a sell strategy in place and following that strategy with discipline will help everyone, all investors, from holding onto a stock too long, just like we saw in 88 Energy. So I just wanted to explore this free carry concept because someone recently said to me, my profit-taking strategy is almost identical to free carrying. So I really wanted to explore this to see if that's true or not. Now, for this example, I'm just going to use a very broad, general example using a company I just made up on the spot, XYZ company. So if you do Google XYZ company and it does exist, it is completely coincidental. So just imagine you bought 1,000 shares of XYZ at $1. So your investment, your original investment, is worth $1,000. Now, something very positive happens to XYZ. So maybe they made a deal with Tesla and they're selling some lithium to that car manufacturing company, and the market loves that deal, and the share price rises to $2. So the share price has doubled. That means your investment value has doubled to $2,000. So the free carry concept would say, why not sell 5,000 shares of XYZ at $2, which means the value of the shares sold is equal to your original investment of $1,000, which means you maintain 500 shares of XYZ as free carry. And the whole thinking around that is you can never make a loss with XYZ company moving forward because you've taken your original investment out, and whatever happens in the future with XYZ company, even if it goes bankrupt, you'll never make a loss with that company moving forward. So that's the whole concept around free carrying, that you take your original investment out and you can never make a loss with that company moving forward. All you can make is a profit. So when I do think of it, this free carry strategy is very similar to my profit-taking strategy, but I just don't like the thought that something is free, because when you do have something free, you do perceive that free thing a little bit differently than if it's in profit. So that's the main reason I don't consider this as being free carrying, because any stocks I hold, any shares I hold are never free. They are my profits. And if I view those profits as being free, I'm going to do different things with that. So does that make sense? I'm not sure. So anyway, that's the main reason I don't really think of my profit-taking strategy as being free carrying. So that's all I've got on this video. When to sell, in particular, looking at the taking profit strategy that I do employ on occasion. If you have any questions about this strategy or any other strategy, make sure you leave a question in the comment section, and eventually I'll get to answer any question you have. Now, I'm not a financial advisor, so if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. Bye.